Today's next presenter is Kassidy Venvertloh. Kassidy will present financial analysis of the entertainment industry. Kassidy's mentor is Dr. Dana Walker. Kassidy, I'll turn it over to you.
So as she said, my name's Kassidy, and I'm a senior this year, and I am majoring in accounting, finance, and business analytics. So I did my project on the entertainment industry, and so financial statement analysis is using financial data to make decisions. So investors will use it to decide whether to invest in a company, and managers use it to track performance, as well as budgeting and planning. And so the entertainment industry was divided into 4 main segments. So you have film, television, radio, and print. And the types of mediums they produce are movies, television shows, radios, newspapers, music, magazines, and books. So the reason for this study is that over the past decade, there have been a lot of changes. For example, we use audiobooks instead of physical books. A lot now we have streaming services instead of cable TV and movie theaters. And we have apps like Spotify instead of radio. So all of these companies in these industries have had to adapt, and I'm interested to see how that has affected their profitability and if they're adapting well or if they're not doing as well in their business. And so the goal of the study was to determine which was the most successful, which would be the most profitable, and then to see if there are any different trends in the company's profitability, liquidity, and leverage. So just some definitions. So profitability is a business's revenues minus their expenses. So it's the goal of the business. If you're not profitable, you won't be able to continue operating. Liquidity, its formula is current assets minus current liabilities. So current assets are assets that can be converted to cash within 1 year, and current liabilities are things that are due within 1 year. So this just tells if a business is able to pay off its debts and operate for the next year. And then finally, leverage is the amount of debt compared to equity. So a company has 2 options to finance. It can go equity, which would be selling shares of stock. This would be profitable because you're getting money, but the bad side is you're giving up ownership in the company, so you're losing some control, but you don't have to pay that money that the investors gave you back. Debt, on the other hand, is cheaper, but you have to pay the full amount back. And the good thing about debt is it also lowers the tax amount businesses have to pay. But debt also increases your risk because as you have to pay the full amount you borrowed back, you increase your bankruptcy risk. So the methodology, so what I did is I got data from Wharton Research Data Services. It is the University of Pennsylvania's data platform. It provides data, services, analytical tools, classes on programming to over 75,000 researchers, 500 institutions, and it includes 350 plus terabytes of data. So it contains a lot of data, and it is quality data. And then I took this data and I plugged it into different ratios. So this allows me to be able to compare across the segments and across the industries. So this is just kind of what the raw data looked like. So it was just in a spreadsheet. So as you can see, it has the company name, it has the different statement accounts like current assets, total assets, liabilities, cash, different financial statements accounts that were taken from financial statements that the public companies are required to report every year. So the companies were segmented based on SIC codes, which is a code assigned by the US government, and it categorizes the companies into industries based on their business activity. So the names of the codes were newspapers, periodicals, which included like comic books, magazines, books, miscellaneous, which included things like atlases and sheet music. And then you had motion pictures, which could be things like videos or movies, so like cartoons, music videos. And then you had radio and cable. So these are just some examples of the companies. As I said, they all had to be public companies since I used financial data. Private companies are not required to publish their financial data, so the only data available is from public. So the newspapers included things like the New York Times and Lee Enterprises, periodicals, Wiley and Sons, books was Scholastic and Courier, motion pictures, Lionsgate and World Wrestling. These are not all of them, these are just kind of some examples. And then the motion pictures were RLJ Entertainment and Bona Film Group. Movie theaters was AMC and Cinemark, and videotape rental was Netflix. And so altogether, across all the segments total, there were 117 different companies, and they accounted for 3.9 trillion in sales total. So there was quite a bit of data to look at. So the first thing I said I looked at was profitability. So these are the three ratios I looked at. So I looked at operating profit margin, and this is their profit from what they're in business for. So example, if you sell t-shirts, it's your profit from selling the t-shirts. It doesn't include interest or tax expense. And so if it's, for example, if your operating margin is 0.5, for every $1 in sales, your operating margin is 50 cents. And so then your net profit margin, this is your bottom line. This is ultimately the total you've earned. And this would be the same as operating margin. Again, if it's 0.5, you've earned 50 cents for every $1 in sales. And then finally, return on assets. So it's how much profit a company generates from using its assets. And then it's net income divided by your total assets. And with profitability, you want these to be as high as possible. It shows your earning. If they were negative, you would be losing money. So this is the operating margin. I split them into two categories. I did print and radio and then motion pictures, just so you can kind of see there weren't as many lines all in one graph. So the periodicals started out with the highest profit operating margin, and then they dropped down. And so your highest is the radio, which would be your orange line, and that was about 23%. So next is your television and movies. And so the movies, the motion picture production had a lot of losses. The one in 2016 was $660 billion a loss. So their operating margin was negative, so they were losing a lot of money, whereas cable was your highest, and they were earning about 25%, 28% margin. This is all together, just so you can kind of view. As you can see, movie lost a lot. All the rest are kind of around 0 to 25. And so these are your actual percentages. So this is your average overall from 2011 to 2021. And so your highest earning was your periodicals. But as I said, that started out high and then dropped. So your most consistent was your cable, which was about 32%. And then as you can see, motion pictures down at the bottom was negative 38. So they were losing a lot of money. So next was your net profit. So this is your bottom line. So ultimately what you're getting. And again, you can see miscellaneous publishing was the highest. So that was your sheet music, maps, just other random things. And then periodicals dropped, and radio had a bunch of dips. So they were losing money in like 2015 and 2020. So then this is the net profit for the television and movies. Again, your television and your movies lost quite a bit of money in your distribution and your production companies. But if you go back to the previous one, most of these were positive for the printing ones, whereas your television and movies were negative. So this is just all together, so you can kind of see. So again, movies were losing a lot, and print companies were earning positively. So this is just comparing operating margin to net profit margin. You would expect operating margin to be higher because you haven't deducted your tax and interest expenses from it. So your highest operating margin was periodicals, and your highest net profit margin was miscellaneous, and then your motion pictures were losing a lot of money. So next I did return on assets. So it's similar to the operating and net income margins, where your print and radio were positive, so their assets were generating a profit, and your movie companies had a lot of negative. And then this is just kind of it all together. So again, the miscellaneous publishing had the highest return on assets, and then your motion pictures were losing money. So next I did liquidity, which is again if the company can continue to function for the next year. And so I did two ratios. The current ratio is assets divided by liabilities, and then the cash ratio is strictly cash. So it is if you have enough cash on hand to pay liabilities. So your current ratio was all positive for print and radio, and your books actually had the highest current ratio, so they had the most assets compared to what they owed, and your lowest was your periodicals. And then for television and movies, they also had a positive current ratio, which was interesting because they had negative operating, so they were losing money every year, but they had enough cash on hand for a positive current ratio. And your television broadcasting stations had the highest cash amount. So again, they were all positive, so they could all feasibly last for the next year. And then your television was the highest, and your motion pictures or your movies were the lowest. So again, this is just strictly cash. So cash ratio was all positive for print and radio, so they had a lot of cash on hand. And same with your movies and televisions. They had enough cash to cover all their bills for the next year. So this could be good if you have a lot of cash because you're able to pay your liabilities. It can also be bad because it means you're inefficiently using the cash. And so the cash ratio was all about half of the current ratio. So finally, for leverage, I used debt to equity ratio, and it measures how much debt the company has compared to its equity. And again, debt can be good because you can use it to multiply your earnings because you're getting money that you can then spend on investments that would earn money, but it can also be bad because you increase your risk of bankruptcy. So your debt to equity for print and radio was all between 0.25 and 3. And then your televisions and movies had negative debt to equity for motion pictures for 2018 and 2020, but it was otherwise positive for most of the other ones. This is it all together. And then this is just the actual numbers. So I looked it up, and the debt to equity ideally is 2, but it depends on your industry. It can vary. Some industries are more cash heavy, so you want to higher. Some industries are lower, so it just kind of depends. So none of these really stuck out as being risky because they were all within 1 to 2. And this is just kind of overall. So as you can kind of see in 2020, the debt to equity ratio spiked up, so more companies were using debt. And that would probably be because of COVID with the cash shortage. They needed more cash, so they used debt. And so I looked at sales overall, so this is just kind of a trend. So as you can see, the cable companies for television were actually increasing over the last decade. And the blue line is your rental companies, which was pretty much just Netflix. So as you can see, that was also the biggest increase in sales, and then it dropped in 2020. But all your rest are, your print companies are consistently increasing, whereas your movie companies are kind of staying flat there at the bottom. And then this was also a trend in net income. And so similar to sales, where your cable company had increases in net income, and your newspapers were also, that was the Netflix was also increasing in net income. And then movies had a drop in 2020, as you can see, which was the $660 billion loss. So in conclusion, for profitability, your movie companies or your motion picture companies were your least profitable, and your most profitable were your publishing or print companies. And then same with net profit margin and operating margin, whereas your print companies were the highest. And this is just the overall leverage of the different companies, which was the opposite of the profitability, where your motion pictures had more debt and your printing companies had the least. So conclusion, liquidity, they are all liquid. It was all positive. And then this was the sources. So the segments and SIC codes were from government. So that concludes my presentation. Do you guys have any questions?
All right, Kassidy, my first question is, all those numbers you reported, are those mean or median?
They were average.
So basically mean, right?
Mean, yes.
So actually, I think it will be helpful if you report the median.
Okay.
So there are big guys in certain industry. Probably for every industry, you do not have so many like observations. So if there is a big guy, there's an extremely small guy. If you average them, you can, it's just like we have in class, right? I always talk about there's one guy, like Shohei Ohtani is 6'4". I am 5'6", so we average a 6. But obviously, it's not very promising for our group to be really tall. But this is my point. You just sometimes have to report more stats.
Right. And
Okay.
I did go and look, and I kind of looked if there were outliers, and I tried to delete some of
Winterize or
those.
delete those?
Yeah, I deleted a couple of them. There weren't as many. They were all kind of consistent, where most of them were losing or most of them were gaining. But there
Okay.
was one that was like -80, where the rest was 0.1 for profitability, so I did take that one, something like
Yeah,
that
because
out.
I figure for profitability ratio, if you got a extremely like small denominator, your result can be really, weird.
Right.
Yeah. So my next question is, for the leverage, what did you do about when equity is negative? It could be possible, right? If I do like, where did you get your book value of equity?
I did the assets minus the liability, so then,
So for the book ratio, sometimes it could result in a negative number.
right. And
Yeah.
I just averaged them all together.
Average them, yeah. So my advice would be like do the debt, right, divided by total assets. So in that way, you probably would get rid of all the negative number. For your ROA, right? You did ROA for profitability.
Yes.
My advice is to do the EBITDA ratio, earnings before interest and taxes, so we can actually zero out the interest and stuff to see how much money the company is making. Because ROA, you have to add back the interest as your numerator to be divided by the total assets. Okay, so that could be really weird sometimes, because if a company is using a lot of leverage, this ratio could be really small for ROA. So, yeah, that's another comment, more like you show less results, and for every result you have to have a conclusion. You don't have to do so many industries all at once. Okay, but overall, really good, and I think you handle the data very good. Okay, thank you.
Okay, so I was pretty interested to see how negative the movie production industry was, considering most streaming services ends up getting the rights to those, and I'd expect that they'd be making at least somewhat a profit. Do you know probably why movie production's been losing money consistently over the past few years?
I looked it up, and I don't know if it's conspiracy theories or if it's real, but one explanation was they created their own sub-companies for things like marketing and distributing, and then these companies charged a large amount. So even though they made a lot of revenue on it, they were paying a lot of expenses, even though it was the companies they created for marketing. So one example they gave us Forrest Gump, where it was like $170 million movie budget, and they made 10 times that in revenues, but since they actually had a negative net income for that movie, so they didn't have to pay out any royalties or anything to people. So I don't know if that's true or if that's just kind of internet, but there were several different kind of explanations like that.
Hidden expenses that not that are beyond the budget that aren't predicted when getting the revenues also maybe.
Mm-hmm. And I mean they have high budget movies where they're expensive to make, and there was also something where it was 80% of movies fail, 20% make a profit, so that could influence that a little bit too.
Gotcha. Thank you.
How much do you think your numbers were skewed by COVID? Because it looked like, 2020, the motion picture industry obviously had a huge drop. And then in 2020, Netflix had a huge rise. So, those were going to affect your overall numbers, right? But if you had, would your results be different if you had cut the survey off before COVID in some of those areas?
They might have, but your movie production was losing every couple years. They were losing a lot of money, and it was kind of where your print industries were kind of consistently gaining. So it may have had an end effect, but I think overall it was kind of the same trend.
I think the other thing you might have found is that the content creation is very expensive. So one of the issues you had with the SICs is it makes the assumption over a 10-year period that the companies are staying in the same industry codes, and you'll see that they're either through acquisition or consolidation or just movement, they're actually moving from industry to industry, and there's a difficult way to control for that, because would you consider Netflix to be a distributor or a streamer, or a creator, right? Thanks. So again, I think those are some of the issues that accounting can't account for that makes the numbers look a little strange at times. Any other things besides COVID and content creation you think, Kassidy, that affected your numbers?
I know there were a lot of acquisitions, so companies would be operating for 3 years and then their financial data would just stop and it would be included in another company. So there has been a lot of kind of turnover or mergers in the past 10 years, so that's also kind of affected the numbers as well.
Okay, so I have a couple of questions. So you did all the trends and your analysis. Did you get into kind of thinking about why the patterns you found happened?
That was kind of the next step. I know I needed to research some of those. Right now I was just kind of doing the data, but yeah, it would definitely need farther.
Okay, and my other question is related then, but do you have an explanation for why the operating income would go way down, but yet the current ratio and cash ratio were high?
I didn't know. I didn't have all the financial statement data. I just had bits and pieces, so it would be interesting to kind of go look at their reports they have to file every year and just see if there was a special event or if they had other income or something that affected that.
Well, you might have things just to help you out, you might have depreciation, which is not cash pulling down your income, yet you would have high cash. Or you might see a relationship between the debt ratio going up and the cash going up, but net income going down. And so that might be a next step in your research when you get your master's or something.
Any other questions? Thank you, Cassidy.